When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
Moving iron.
Hello and welcome to Moving Iron Podcast. Marcus with Shawn Hackett. Shawn Hackett with Hackett Financial out of Boca Raton, Florida. He's nice enough to come on and talk about what's happening in the world of the commodity markets. So, Shawn, how you doing, bud?
Very good, very good.
Love to have you back, man. It's been a week off here. I had Moving Iron Summit, and for whatever reason, I was busy, so I didn't have a chance to run you down last week. But I'm glad you could come back on this week.
I just hope everybody got their enough napkins and silverware.
Yep.
So.
They got plenty of napkins, silverware, and some pizza cutters. So good times.
And make sure they got their free Ginsu knives. So.
That's right. That's right. Exactly right. All right, man. Let's take a look at what's going on in the marketplace. So last week Tuesday we had the report come out. Not a big shocker there. Not a big cascade moment by any means, one way or the other. Felt like to me maybe the market had already anticipated what was going to happen, and the USDA maybe played it a little bit safe. But I guess, Shawn, what's your reaction so far this week to what you've seen since Tuesday?
Yeah, the USDA never gets to the final number here in September. They never do. They are incrementalists. They incremental. Small crops keep getting smaller has been an adage that has been held true through the annals of folklore of grain market history, that once the yields start coming down, they keep going down, and they eventually get around to the right number. Typically by January, they finally come out to the number they're going to stick with, rightly or wrongly. But the crops are going to get smaller. Now we can argue how much smaller they're going to get, but they're going to get smaller. And so, that's the concept of an early harvest low that we've been talking about for a while, that we thought we would get this late August into mid-September early harvest low develop, because I thought that the market would start to get a sense that these crops are small enough that, we've already, as you said, priced in the bearish news, and we might not have been pricing in this bullish news. And obviously now as we head towards South American planting, and of course the winter wheat crop planting, especially in Russia, Ukraine now, we're starting to shift. And of course, what's really going to drive the market now, Casey, is the word coming off the combines. As the combines start to roll more aggressively, we start to hear what we're getting. The market's going to get a sense for how much lower do we need to go on crop yields before we think we've gotten ourselves low enough. And, there's people are bewildered that the corn market didn't go down this week on 2.2 billion bushel carryout. And remember, spreadsheets are what they are. It's a spreadsheet. The numbers on there are not real. They're just fictitious numbers that are put on a page based upon someone's expectations. It's not real. 2.2 billion bushels is a theoretical number that the USDA is suggesting could be the case come next summer. But when we look at yields likely further declining here, and we think demand's way under being under forecasted. I mean, we think demand's going to be considerably stronger over the next 12 months. That when we work through the likely numbers, forgetting whether, any weather outcomes for the future crops, we think we're going to be closer to 1.5 to 1.6 billion bushel carryout when it's all said and done. We're not going to get there tomorrow, but I'm saying, over the next 3 to 6 months, we're going to get to a more middle number like that. And I think that's why the market is resisting. It doesn't want to go down. They've thrown all this bearish news on corn. It's just not going down. The market senses that the USDA is not correct. And I think that as the market begins to reprice that reality, we're going to see the corn market start to push itself back up here post-harvest. Remember, certain farmers don't sell. They screwed up. They should have done it. They meant to do it. Their phone. They lost their phone. They didn't get the cash sale made, and they have to sell at harvest. But once that's done, there isn't a farmer out there who's going to sell a bunch of corn down here. It's not going to happen. They're going to put it in the bin. They're going to lock it up. They're going to say, come get it sometime in 24, and that's your post-harvest rally. That's why you get a post-harvest rally. If we're correct with our overall weather synopsis, which we put out to our subscribers a few weeks back, we're very, very concerned about drought risks in north, central, and central west Brazil this coming growing season, both for Mato Grosso soybeans, 50% of production, and for second crop corn, 75% of corn production. We're very concerned that we're going to have major drought problems in that area. And of course, Brazil is the big dog, is becoming the big dog in both of those. And that to me says that future production potential for Brazil, which was fantastic last year, is going to have to be throttled back down. And then lastly, of course, our work says we're going to be back into a neutral La Nina weather pattern next year in the U.S. growing season, which means that the El Nino weather everyone thought we were going to have this year didn't happen. And the El Nino weather everyone thinks we're going to have next year isn't going to happen. Drought risks are going to be back on the table. And then the only question becomes, is it a near miss like this year in terms of Gleisberg cycle, type of extreme drought? Even if it's a near miss, it still means production falling below trend. Casey, we have not had a trend line yield crop in 3 years.
Right.
And I don't think, if I'm looking out for next year's growing cycle and 25, I don't think we're going to make trend line in either of those years. And I think the risks are high of a more extreme Gleisberg cycle drought, which means we're going to have 5 years from what our weather work suggests of not having trend line yields. I'm not sure I don't think that's happened before. I'm not aware of having 5 years of below trend. We've had 3, but I don't think we've had more than 3. So if that is correct, then that would be an unprecedented period of weather volatility, not allowing the U.S. farmer to produce a trend line yield crop. And that is going to be a more common feature in this new weather volatility cycle that we've talked about in your show for years now, that is ongoing and it's going to continue to be ongoing for the foreseeable future based upon changes in the sea surface temperature profile of the Atlantic and the Pacific and the throttling down of overall solar sunspot activity. And so this is the other thing that I keep looking at is, insurance companies are woefully under reserved, meaning they're continue to reserve against future payouts based upon the last 50 years of weather and property destruction. And in the last 5 years, they've had 100 years worth of claims in 5 years, and they're just woefully under reserved. I mean, they are so upside down, Casey. So what that means is insurance premiums, including farm crop insurance, is going to continue to escalate. We talk about inflation. We're going to talk about property casualty insurance inflation like we've never seen before. And at some point, I think the government's going to have to bail out the industry. The industry is not, they're so far behind the 8 ball in their reserves and what their liabilities are against their reserves. I don't even think they can get themselves out of the mess that they're in. So that is something that producers are going to have to factor into their cost of production, is that the insurance component is going to just get out of control. And, we always talk about fertilizer prices. We always talk about seed prices. We always talk about cash rent. Yeah, but the insurance price premiums, cost inflation is going to be very, very extreme. And I just think that's a ticking time bomb that isn't going away anytime soon.
Yeah. That's a good point you brought up about insurance companies. And I've been seeing a lot of that kind of start to pop up a little bit here with the amount of wildfires and some hurricane stuff that we're seeing, just some as these weather patterns change and draw more extreme weather, I guess is the best way to put it, in in very erratic form. It's not like it's huge, just nonstop, one big deal. But it's just these little things that happen. But when they do happen, they're very intense. And so,
the way I'm not an insurance person, but the way I would be looking at insurance is you have to say to yourself, are we correctly reserving against the inflation of the assets that we're protecting, right? Well, we know we've had wild inflation, and the price of things are through the roof, and they're not correctly increasing their reserve rates at the level that the value of what they're covering. That's the first thing. Secondly, we're having, as you said, a greater number of very significant, highly amplified damage events that then mean that you have a larger event that is affecting a larger area whose assets are now inflated at an accelerated rate. They're just not reserving correctly. And it's a big problem. I almost feel what's ultimately going to happen is I think that we're going to have some kind of a, kind of like Farmer Freddie Mac, where they have a quasi government guarantee behind them. I almost feel the only way the insurance industry can work here, based upon how far behind the eight ball they are and what their reserves are against future payouts. Mm-hmm. I think that the U.S. government is going to have to back them up with a quasi guarantee against payouts exceeding reserves. I just feel like we're heading towards an property casualty insurance crisis, including crop insurance.
Yeah.
So.
Yep. Okay. All right, man. Good points there. All right. So let's talk a little bit about what you see happening right now with the cattle market, as you're looking at what's going on there with these changing in prices and stuff like that on the corn side. We're starting to see some development of what could be a shorter crop than what some people are anticipating. How do you anticipate watching the cattle market over the next 3 months here going into the first year?
Well, everybody knows, at least for the U.S., that the future supply of cattle that can come to the market to create future supplies of beef are going to be historically low, if not record low, over the next 12 to 18 months. That is established. We can mess around with the weights a little bit, but for the most part, we just know we're not going to have a lot of supply. So what it really comes down to is what price level is it going to take to bring enough beef in from foreigners who have more supply? And what price is it going to take to get the consumer to back off, to kick the can down the road, so that we can get the increase in the herd and start getting more animals coming to the market a couple of years from now. When we look at the current price, approaching $2 and on the lives, and obviously $2.50 on the feeder cattle, we're at levels that historically are very, very high and typically have done that job. And so the question is it different this time? Do we need to do more than we've done in the past? Or are we simply going to be sitting here in sort of a topping out form, meaning not, just, oscillating at this high level, just buying time or not? So far, the market made new highs yesterday, Casey. I believe that both, if you look at the futures of live and feeders, they made new rally highs yesterday on continued lack of supply and demand being stronger than expected. I continue to look at the Brazilian cattle price that's dropped 30% in the last 6 months. I continue to look at the Australian price that's dropped 40% in the last 6 months, wondering how the U.S. can maintain such a high price level relative to the largest exporter of beef in the world and the third largest exporter of beef in the world. So far, we've been able to do it. So I still feel, in the world of being a producer, your job is to manage risk. You have prices that are profitable, that are working, and yes, they may continue to work, and yes, they may continue to go higher, but your job is to make sure that in case there's a rogue wave economically that comes along and knocks the market down and takes the cattle price with it, that you aren't sitting there wondering why you didn't take the money home on the farm. So in the least, if you're not comfortable making cash sales because you're afraid the price is going to go higher, put some protection under the market that keeps your top side open but protects the price. To me, it's an absolute risk management no-brainer to think about managing that risk on the farm as a cattle producer. When you're looking at hog producers with the biggest red year that we've ever seen in history, and dairy seeing the biggest red year we've seen in history, and just coming off the cattle industry seeing some of the biggest red they saw ever a couple of years ago. Just don't lose sight of prosperity never lasts forever, and you have to get you have to take the good when it's there.
Yeah.
So this is not about prices. It is about just doing the right thing and making sure you do what you need to do, because we all think we know for sure what the future holds. Obviously I'm in the job of predicting the future of everything. But I can tell you as good as I think I am and as smart as I think I am, you can't know everything, and things can surprise, and you can make mistakes. And so anyone that thinks that there's no chance that the U.S. cattle price can go down, it's impossible. History says that is not a good place to be as a producer. There always is a surprise that can take the legs out from underneath. No pun intended. So
that's a good one, Shawn. They had a rally of sorts that we've seen in the sugar market, and the sugar market is obviously something I'm going to pay attention to now because it's sugar beet harvest season, and we're going to see what those sugar content in ton looks like. As you start looking up at what's going on right now, we see sugar at about 27 cents a pound. So I guess, Shawn, as you're looking at what's going on there with the sugar market, what's your thoughts there?
Once in a while, Casey, a market gets into a situation where you get into a supply demand rationing crisis. We saw this in the oats market a year and a half ago, where it just went off. The lumber market saw this. The orange juice market just recently saw this, where it just got into a spot where there was just no supply, and it just blew through anything remotely historically high. And the sugar market has the potential for that, meaning we've had 2 years of deficit. We're moving into year 3. We've had a very poor monsoon for India. They've banned exports as of October, sugar exports. And we now have had a 1 in 100 year to 1 in 200 year flooding event due to Typhoon Haiku that came into southern China that produces 85% of the sugar in China, which means that their sugar crop is in a world of hurt. I think that's the tipping point. There's always a tipping point that puts the market into the panic phase. And I just don't see how, this market has correctly priced this kind of a shortage yet. I just don't see where we've done that yet. And you look at the chart breaking 27 cents. I mean, only a couple of 2 or 3 times in the past have we been any higher. In the 70s, we got to 65, 70 cents one year, and then we got to 45 to 50 cents one year. Since the 70s, the high price has been about 35 to 40 cents. I always say blow-off tops can't be predicted. They're highly emotional. Other than to say, it looks to me like, we are in a very dynamic, rapid price discovery mechanism where the market's going to quickly try to find where it needs to go to settle the score here on what looks to be an historic perfect storm of everything that could go wrong goes wrong shortage here in the sugar market. And so that's where we are. And so if you're a sugar beet producer, obviously you have you're selling to the domestic market, but to the extent that you can export some of that to foreign buyers, I mean, those are going to be some pretty profitable sales.
Yeah.
So.
Cool. So you got something good to look forward to for a little while. I haven't had a year where sugar beets they've always kind of been average here the last 5 years. Now we got a chance to really make some money on them. So that'll be great, assuming the crop comes through.
I think it could create a pretty sweet return. That's for sure.
Awesome. No pun intended, right, Shawn?
No pun intended. Just I don't know how this keeps happening. Don't know.
Right on. All right, a couple more things, and we'll wrap it up here. I guess as you take a look at weather patterns going through the end of fall here, if you start, we're hitting to September, hitting that last quarter of the year, going into that first quarter. Basically, some people call it fall in Nebraska. We just call it winter. And So
Well, it's like Florida. We have the hot summer, and then we have the cool summer.
yeah.
That's
Well,
our two seasons: hot summer and cool summer.
we have cool summer for about 2 weeks, and then we get winter for the next 9 months. But I guess as you look at the how these things are playing out, Shawn, we're starting to see some cooler temperatures roll through this week in most part of the United States. And as you look kind of long term, those cooler temperatures start to stick around a little bit longer. What's your weather pattern saying through the last quarter and the first quarter of the year?
Well, for the planting season, we always want to worry about wet weather during October. Sure. I think we're going to get some wet weather. It looks like the El Nino atmospheric response is finally going to start establishing itself, which means typically a wet fall. So that would mean that's good for the river, by the way. But Mississippi River, keeping the flow, but it could slow down harvest considerably. So be on the lookout for potentially some excess wet weather, some potential, frost in the north. But to me, the bigger thing to watch is Russia, Ukraine. They're trying to get the winter wheat crop planted now, right? So obviously the number one region in the world for wheat exports, they rule the day. And when I look at Ukraine and Russia, they're extremely dry. When you look at the next 30 days expectation, it'd be some of the driest 30 days between now and, let's say, mid-October in 35 years. That's not good for trying to get the winter wheat crop planted on time, or if it gets planted on time, getting it planted in the right conditions for good establishment. One of the big problems for the wheat market is that Russia has had a couple of good growing seasons due to a very good start to the planting season. This could be where they get caught against the 8 ball and are really not going to get the acres planted and are not going to get the establishment planted. They're not going to have the crop potential that they've had in the last few years. In fact, the potential could be quite poor if they get off to that kind of a slow start. That should start to impact the market, Casey. I think in the next few weeks, the market's going to start paying attention to that. What happens in Russia and Ukraine does not stay in Russia, Ukraine. Forgetting the war I'm just talking about weather now. This is just weather. And that could be a big, big story. Remember, the seasonals in winter wheat are now strongly up into the fourth quarter, meaning the winter wheat market likes to rally this time of the year, especially if it can find a good story to get them excited. I think a Russia, Ukraine, too dry to get the crop planted story would be a very significant catalyst, fundamental catalyst, weather catalyst that would help support a typical upseasonal, the war notwithstanding, whatever that may or may not do. So I think if I'm looking at the biggest impacts for let's say the next 3 months, I'd be paying attention to Russia, Ukraine. I think that could be the place that is the catalyst for some kind of a grain, corn, wheat, short covering rally, whatever you want to call it, that gets some of the bearishness in the market and makes them think a little bit differently about that. As I said earlier in the show, I'm very concerned, not about Argentina this year, but I'm very concerned about Central North, Central West, Brazil drought, December through March. I'm really worried that that's going to be a feature that, and because we learned last year that Argentina, even though they had a half a crop, it didn't really impact the market that much because relative to Brazil, they're really small. Relative to the U.S., they're really small. They're big in the world, but not big. They're not big enough to matter that much. But Brazil is.
Right. Yep.
Sure.
I
continue to believe that we've been accustomed that the big weather rallies occurred during our growing season because historically we were the big dog in soybeans and corn. Now that Brazil is becoming the big dog in corn and soybeans, we may see bigger weather rallies now during the winter, spring months versus our summer because Brazil is actually starting to matter more to the global balance sheets than the U.S. Doesn't mean the U.S. doesn't matter. It doesn't mean it's not important, but I think Brazil actually might matter more now in the psychology of the market in terms of weather problems. And your bigger rallies, your bigger price spike peaks that typically have occurred in the midsummer may occur in the mid-spring. Instead, we need to maybe shift our marketing strategies backward a little bit based upon the shifting production profiles of Brazil versus the U.S.
Yeah. Okay. All right, man. Lastly, I asked you this question on another podcast that I can't find anywhere to save my life. Was it last January, January 20, that they had the Tonga volcano eruption, or was that in 21?
It was early 21.
Early 21. All right. So now we've had something like, 70,000 U.S. Olympic pools worth of water vapor get blown up into the atmosphere from that. And plenty of white papers have been written about it because nothing in recorded history has ever been matched about with that magnitude. So here we are, basically two growing cycles worth of information that we see right now, Shawn. And as you take a look at what's going on now, you had hinted towards earlier when we talked about this, that this water vapor was going to have an effect, just didn't know what it's going to look like yet. And some of these warmer temperatures that we've seen over the last couple of years, and a lot of stuff that I've read and some stuff you've talked about too, are kind of pointing towards that water vapor as something that could have been causing these temperatures. So I guess, what's your thoughts there, Shawn?
Well, it's undeniable that water vapor is the most powerful greenhouse gas on the planet by far.
Sure.
And when you pump that much of it in the stratosphere at one time, doubling the concentration overnight, one could certainly speculate that there would be a warming effect over the 2 years hence. Yep. It's never happened before. We don't know the extent. Obviously, there's other factors that drive temperatures. It's just not stratospheric water vapor in the stratosphere. But what one would have contemplated, and many of the papers from people who are far smarter than me, who have multiple doctorates in subject matter that I couldn't conceive of understanding, speculated that hot weather extremes would likely be a consequence for at least a couple of years, and we've seen that. We've seen temperatures exceed in many areas, the highest temperatures ever seen in recorded history. And once again, we can't know exactly how much of that was specifically due, but we have to believe that that was a fanning the flame with lighter fluid event. And so I think that the papers and the research and the expectation that we would see hot weather extremes has proven to be correct from this. But it looks like it's going to start to dissipate, meaning when you look at the atmospheric aerosols in the stratosphere, Casey, don't stay there forever.
Right.
They'll stay there for 2 or 3 years, and then they start, sulfur dioxide precipitates out, so does water vapor. And we're starting to see the water vapor begin to precipitate out of the stratosphere. And so I would think this is the last year of seeing the Tonga effect be this extreme. There could be a little carryover effect next year, but I think we've seen the extent of the hot, dry weather extreme potential for the Tonga was the last 2 growing cycles. And I think that effect is going to be largely diminished as we go forward. And then we will get back to other factors that drive temperatures, not this, rogue wave event that took place that's created an extra kicker for a couple of years. So the answer is, I think we now have a pretty good handle that there was a strong warming effect, but that it should be winding down now.
Awesome. Okay, man. Shawn, good one as usual. Folks want to reach out to you, get more information about what you're doing over at Hackett Financial. What's the best way to do that?
We have a Twitter page at Faradex11. We have a LinkedIn page as well. Plus, we have our website at Hackett, HACKETT advisors.com, where we, from time to time, put out interviews with you and others, and sometimes, put some quick posts out there on some things that we're looking at that gives everyone an idea of our fundamental weather work and what our forecasts are like. See if what we do and how we do it might be of value to those that are involved in agriculture.
Right on. Shawn, I appreciate you being on the podcast, man. Look forward to talking to you next week.
Thanks, Casey. Talk to you soon.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC, LinkedIn at Moving Iron Podcast, and go over to the YouTube channel, see the video version of this at the Moving Iron Podcast YouTube channel. I know, it's clever. I know you guys were shocked by that. Go to Moving Iron LLC for everything Moving Iron related. And just got back from the Moving Iron Summit. I want to thank everybody that came to that and was a part of that, and all the sponsors and stuff that helped put that together and make that possible. So without you guys, that would not have happened. So with that, I'm Casey Seymour. We're Shawn Hackett. Let's move some iron, folks. Yep.
Moving iron in the 21st century.